I know we have a giant backlog because we've been gone for a few weeks.
Most definitely.
So, so who wants to go first?
I'll go first. So we did have a question that came in. It's a general tax question. Someone wants to know what's the smartest move someone can make right now to lower their 2025 tax bill?
Okay, so
That's a big
yeah, it depends. Yeah, and that is the answer to all tax questions. But so it depends on what your situation is. So if you were a W-2 employee, what's the biggest thing you can do to save on taxes? The easiest thing to do is to contribute more to your retirement account. You'll hear that from financial planners and everything. It's like, oh, just put money in 401k, it's tax deduction, blah blah blah, which is true. Um, but it's not necessarily the most powerful because there are limits involved. You could do things like get into investment property because there are lots of advantages to doing rental real estate. You could start your own business and be able to change the order of things. That's generally the most powerful one. So, the difference between an individual who earns money as an employee and somebody who's a business owner is that an employee earns money, then they get taxed, and taxes are taken up front, and then they have the remainder to spend. A business brings in revenue, it spends on expenses, and then gets taxed on the remainder. So that difference in order makes all the difference in the world. People talk about Amazon all the time. It says Bezos didn't pay taxes for 20 years, which is true. He didn't. And the reason was because they reinvested all their money for 20 years and had no profit. And they were just selling on the stock exchange the dream that one day they would turn a profit because they're building this bigger and bigger thing. And it worked. Sometimes it doesn't work, but that is the game. So they had no income with which to pay tax because they spent it all. And on a business side of things, you're only taxed on the net, not on the gross. As an individual, as an employee, you're taxed on the gross. And so if you change those things around, move those pieces upside down, then that's going to be, in general, your most powerful tax saving strategy. But that's not available to everybody. So it depends on your situation, depends on what you can do. And part of the difficulty of the tax planning world is that everything is unique. Everybody's situation is different. Even if they rhyme with others, your number is going to be different than the person next to you. If you need more specific help than that, then you'd set up a call with one of our planning experts, and we could figure out your particular situation and what you can do to save the most on tax.
Because all our plans are personalized to the client.
Everything is custom. Mm-hmm. I wish it wasn't.
Yeah, it would be a lot easier for us, but hey.
That's why if you want to do the DIY approach where I know my own situation, I just need pointers, that's what our navigators group is for, where you can have access to all of our tools. It's the same tools we use internally and that I've built over the years, and then you can use those tools in your own situation. So that is an option for those people who are more do-it-yourself oriented.
Yeah, we have a question, boss, from one of our clients, and he asked if someone runs a side hustle at one point, should they treat it like a real business for tax purposes?
Absolutely. So that should always be treated. There's people get hung up on this hobby loss rule. So you've probably heard this thing: if you lose money in 3 years in a row, then it's not a business anymore. And that's a vast oversimplification. But what does happen is that there is this concept in the tax regulations of whether something's a hobby or a business. So if something is a hobby, you do get taxed on the gains. You do not get to deduct the losses, which is crazy, right? But it's just how it is. So if you make money just by happenstance, you owe tax. If you lose money because it's a hobby, that's just you spending money. But if it's a business, then whether you make money or whether you lose money, you're going to have tax implications. Most businesses, at least in the beginning, lose money, and most businesses fail. So most businesses lose money every year, as a matter of fact. And so then there comes into this question, is like, what about this 3-year thing? And so what the 3-year test is that if the IRS were to come in and examine your business activity, If you lose money in 2 out of 5 years, then the burden of proof is on the IRS for them to prove that you don't have a business and that you do have a hobby. If you lose money in 3 out of 5 years or more, 3 or 4 or 5 out of 5 years, and the IRS were to come in and examine that, the burden of proof is on you to prove that it is a business and not a hobby. So that's where the roles get reversed in that 3-year thing. And what does that mean to prove that you have a business? That means you do the things a business does. You have a separate entity, you have separate bank accounts, you don't commingle funds, you maybe have a website, depending on what kind of business you have. Maybe you do some advertising, you keep your books in order. You're required to keep records as a business. For a hobby, you're not. You should if you're making money. If you're just spending money on whatever. So what's a hot hobby right now? I keep seeing, maybe it's just my algorithm on Twitter, but I keep seeing these guys who are, they're these tether cars that they're racing at 200 miles an hour around a track.
Really?
Yeah, it's just, people are into all kinds of stuff. So if that's your hobby and you're spending money, then you don't really have to keep track of anything. But if you're making money and you're winning prizes or whatever, then you do have to keep track of that sort of thing. So if you have a side hustle, you should absolutely be keeping track of things, in a real business kind of way. Separate accounts, whether that's into an LLC or a corporation or just under a DBA or under your personal name. Those are different kind of questions. But you should definitely have a separate bank account. You should be keeping track of income, keeping track of expenses, and doing all the things that have the form of a business because you do have a business, regardless of how big or small it is. Yes, that is one I can answer definitively. Treat it like an actual business because it is.
I'm just thinking to myself that when a person opens a business, they think that's it. No, that's only the beginning. It's so much more to owning a business.
Yeah, it is. There is work involved.
Yes, you have to do work.
It'd be nice to just say, "Oh yeah, it's a business," and then just be done. That's not real life. Yeah.
So it looks like we have another question that came in. It's a real estate question. Someone wants to know, how can a W-2 earner take advantage of the real estate losses on their taxes?
Yeah, so the real estate losses, there's three different scenarios. So rental real estate, by default, unless an exception applies, is considered passive. And so under passive activity rules, you are limited to $25,000 of deductions. Now, another thing about rental real estate is that for tax purposes, it's almost always a loss. Because even if you're cash flowing positive, you have rent, but then you have expenses, you got your mortgage, you got your utilities, HOA, whatever, you might have a positive number there. But in rental property, we also have depreciation, which writes off a portion of the structure over time. So with standard kind of depreciation, you're generally writing off about 4% a year. And that is usually enough to kick you into a loss for tax purposes. So the question is how to use that. So you can use up to $25,000 of losses if your income is under $100,000. And so let's say you have a W-2 of $80,000 and you've got 3 properties which are generating a whole bunch of losses combined. And so you'll have a minus $25,000 on your Schedule E, which flows through Schedule 1, which flows into your 1040. And that's going to reduce your income from 80 down to 65 or 55. And that lowers your taxable income and that lowers your tax. So that's thing number one. As you make more money, that deduction of $25,000 shrinks. Once you get to $150,000, it goes to zero. And whatever tax losses you have generated over and above zero carry forward into the future. That's called you look at your Form 8582 for your passive activity loss limitation disallowances. And so that money rolls forward year after year, building up in many cases, until either your income is low enough in order to capture that $25,000 a time, or until you sell the property. And at that point, those unused losses will decrease the gain that you have to pay tax on, if there is a gain. So that's scenario 2. Scenario 3 is where you're a real estate professional and you're able to demonstrate that you, or I want to say you, a lot of times it's a spouse or something like that, spending at least 750 hours a year and at least 50% of your time involved in real estate activities. And then there's a grouping election, and there's specifics that go into all that. But if you're able to satisfy those scenarios, then you're able to convert that passive activity into an active trader business, and then you can take those losses without limit against your other income. So that can be extremely powerful if it applies to you. And there's various ways to do that.